Welcome back to the channel. As always, if you are copy trading, you are an absolute moron and you deserve to lose all your money. And with that out of the way, we're going to speak today about a stock called MRVL Technology, ticker MRVL, trading at $80. And in case you haven't heard about this stock, is a company that has been rising a lot over the last few years, but has a long history in terms of what they do. So as you can see, they were listed in the early 2000s and has been flatlining for many, many years up until the advent of AI. So of course, that was a massively successful thing for them. And that, I believe, is the reason why the strength of this trend is starting to wane. So when you look at the long-term trajectory, of course, there's these peaks and troughs and so on. And at the moment, we seem to be at yet another peak, but lower than before, and that's throughout a long time frame. So you can see that this moving average, which is the 250-day one, uh, is currently turning around. And of course, that is motivated by this big move. And I think this is only the start of a new bearish long-term trend. So let's delve into what is driving that. So imagine that you are building a gold mine. You probably know, you have heard about the example of the picks and shovels, right? When everybody's looking for gold. And the best way to make money is to sell the shovels. In this particular example, the gold mine is the AI data center. NVIDIA is the architect selling you the gold mining machine, which are the GPUs. Marvell is the plumber. They sell specialized cables and connectors that link machines together, and they help you design custom tools if you want to build your own. So for the last 18 months, the company bet its entire existence on this one job. So they sold off their businesses, cars, 5G, to go all in on AI. So as you can see, in late 2024, that was very successful for them, right? Following this upswing that started in mid 2023. But I think things are going to start turning sour for them. At the moment, the company is priced about 20, just under 24 times next 12-month earnings. That is a discount to the overall sector. However, when you look at the price to sales at 7.2 over the next 12 months, it is still quite significant. So this is a company that has a big capex expenditure, right? They have to constantly upgrade the technology, and it is one of those business models that can take quite a while to readjust to the new cycle. And at the moment, with this valuation, and if we look at the estimates, right, they seem to be quite rich. So they're expecting a blowout next quarter, and they believe that sequentially, every single quarter out there is going to continue getting better and better quarter after quarter consistently. Having said that, the their clients just found a cheaper replacement for them. And that's where I see the start of this bearish thesis playing out. So you can see this big gap here to the downside. That happened on the 8th of December when reports leaked that Marvell had lost two of its two biggest future contracts to competitor Broadcom, an AI chip, another competitor. So as you can see, there was a big a big downward move, right? And let's say we gave the stock a few days to recover, and it did so, but now it's going down again. And you see this long-term trend starting to turn around. So why is that all important? Well, the numbers in the previous quarter were already not the best. In Q3, in their earnings report in December 2025, their custom silicon revenue, which is their AI growth engine, actually declined sequentially. And management called it lumpy. But when you have these kind of expectations for the business, right, which is so benign, I find that hard to believe that you can have a lumpy quarter if you are so sure about the numbers with such high expectations. As a matter of fact, after that, you see that expectations on EPS gap, yes, they have been revised down, but on a normal basis, they stayed about the same. And sales are still expected to continue growing significantly. So I get the feeling that management might be not cautious enough in terms of where they are, and we'll explain why in a second. So the gap gross margins is only 51%. One of the main competitors, which is Broadcom, is 75%. And like I mentioned before, they're spending massive amounts on research and development, about 500 million quarter, to win designs that they are now losing, right? So, like I said before, this was reported in the news. You can see how the press is starting to make echo from this. And further to those, there were also concerns about Amazon working in partnership with Microsoft to design a new type of microchip, right? So that is additional competition that they're having, aside from actually losing customers. And when you look at the market share that these guys hold, it's about 20 to 25% in terms of market share that they compete for. But what if that starts shrinking, say, to single digits? And the narrative, right, that put them here not so long ago, which is the AI sort of label that is making everything grow so much now, is broken. What if they lose that status? This could be one of the first big losers that we see from the AI race, because effectively they might be expelled from it. They might be ejected out of the AI race. So when you look at the way I'm building my portfolio at the moment, there's some AI names in there. This provides me with good protection, whether it's idiosyncratic in terms of what is happening to the stock, but also the sector, and of course the downturn, because this is still a high beta name. So coming back to management, they guided for 25% growth in 2027. But if they lost these contracts, or perhaps they lose even more, that revenue could be flat to down. And that, of course, would cause, as I mentioned before, to lose that status and the multiple to compress, which at the moment, let me just hide this here to make it easier to see. So this is the valuation in terms of next 12-month PE, right? And you can see that right now they're somewhere in the middle. But there have been periods where they have been just on the low teens. So that provides us with ample profit zone, really, to make money out of the stock. So what's going to drive all this? Well, really, we cannot predict when reports might be leaked. And this is why I'm probably going to start this position sooner than I normally would. An optimal entry point would likely be waiting for breaking this currently upward channel. But seeing this price action and these moving averages turning sour, and considering that these reports might come anytime, I'm happy to start this position at the moment. So of course, the Q4 earnings guidance happening in late February to early March. Their earnings are expected on early March on the 5th, although it's not confirmed. That will clarify whether or not this previous quarter was about lumpiness or indeed there could be some fire into this smoke that we're seeing. But of course, we'll have to pay attention to what competitors and other members of the ecosystem are doing. The NVIDIA conference is happening in February, March, and it is likely that they unveil a new next generation chip. So if they announce that they're moving into more interconnects in-house, cutting them from the supply chain, that business from MRVL faces an existential threat. And at the same time, we have their main competitor, Broadcom earnings, which I think is happening around the same time too, on the 13th of March. So let's say, for example, that earnings and guidance don't necessarily move the stock much. This provides us with an additional catalyst that we can stick to, right, past that earnings date to potentially capture more downside. So in terms of how I'm going to play this, it's quite simple, really. 2-for-1 calendar ratio spread, buy some contracts of the April puts and sell a contract on the 70s in March. That provides us with over 100% return, but of course it would be a lot higher if we stick to the position past the March expiry. Potentially, it might enable us to restructure it, and then you can quite easily get to a 3x return. The price target is 60, although I think realistically, if these things do play out, and we have just around here for that to happen, I think that's quite achievable. Hope you enjoyed the video. See you soon.